Hello, Stephen Koukoulas here, Economist-in-Residence for the wonderful Zagga group, and wow, what an update this one's going to be. It's all about oil, petrol supply, inflation, interest rates. That's the dominant sort of array of factors influencing the economy, financial markets, and the thinking of our friends at the Reserve Bank when they meet in a few weeks' time to discuss whether we need another interest rate hike or not. So, fairly clearly, while it's a very rapidly moving feast in the Middle East in terms of oil supply and oil prices, it does appear that we might be a tiny step, and I don't want to overstate this because it's such a volatile situation, but we're a tiny step closer to some form of resolution. As I speak and record this, the oil price is a little below US dollars 100 a barrel. It got to $115, so it's down a bit, but it's still well above where we were pre-crisis, when we were tracking around that 65 to 70 US dollars a barrel. So prices are still, markedly higher. So the longer that this continues, the longer the cost pressures on petrol, diesel, aviation fuel and the like will continue. The effect on other prices and the availability of various materials and goods will also be impacted, and that's the dilemma. That's the issue. Now, we know that since the oil shock started, we've had a major decline in consumer sentiment. Things like the housing market, well, the auction clearance rates have sort of tilted back down, and we're now seeing prices in Sydney and Melbourne actually falling, not hugely, but they're actually tracking a little bit lower. The boom cities, if we can call them that, Perth, Adelaide and Brisbane, clearly, the rate of increase is slowing a bit. They're still increasing, don't get me wrong. We're not about to see prices fall in those cities, but we perhaps are seeing the early stages of the, blow to consumer confidence and the concerns about the economic outlook sort of permeating through the economy. Now, as you probably can guess, we don't have a lot of data yet on what the oil shock has actually meant for the economy. It only started in the beginning of March, so we need to see March, April data, and here we are in the middle of April. So we need to get more information coming through. Suffice to say that we know from history, that we know from other examples, that when we do get this oil price shock hitting an economy, it does lead to weaker economic growth and higher inflation. So for our friends at the Reserve Bank and interest rates, we've still got a couple more rate hikes priced in. The official cash rate is currently 4.1%. The futures market at the moment's got about a 4.7% rate priced in. So that's roughly 60 basis points of hikes priced in by the end of the year. Now, markets have been proven wrong in the past, so things can change very, very quickly. But for the RBA, they've got to trade off this position between a weaker economy and presumably higher unemployment versus getting inflation back to their 2 to 3% target very quickly. And with two rate hikes already in the bag, perhaps the RBA can sit tight for a month or two before deciding what to do next. And as we mentioned, and as we know, this conflict could, I'm being optimistic, could resolve itself that the Straits of Hormuz are reopened, supply starts cranking up again, and we get that oil price sort of tracking back to where we were pre the war. Now, having said all of that, we do know that there are signs that the housing construction sector is doing very well. The month on month, the numbers are just crazy. But last month, we saw a near 30% increase in the number of building approvals, a fresh new 5-year high. A lot of it was the approval of apartments in Victoria, but nonetheless, we've got now housing construction on some form of upswing. Now, that's in the context of higher building costs and extreme pressure. You think that that'd be great news for the building sector. However, they're confronting higher costs, higher prices like everyone else in the economy. So while the construction side of the ledger is looking good, the cost side could well be the constraining factor on new construction of dwellings in the period ahead. So all in all, look, economics is always uncertain. Anybody who's been following these recordings over the last couple of years would know that. But at the moment, the uncertainty is even more acute than ever. That said, we're starting from a position where the economy ended 2025 on a solid note. We knew it was going to slow. The question now confronting all of us is how slow will the economy be? And the critical swing factor in all of that will be us consumers, you and me. how much we, the household sector, will be spending. At the moment, it's looking a little bit weaker. Certainly the internal data from the big banks is showing that our use of credit cards and the like, and debit cards and tap and go sort of payment systems is actually slowing. We're not silly, we are responding to these price pressures coming through. So in summary, high inflation, lower economic growth are the sort of two key factors going forward. How long they last is the big question, and how deep or how high they go is the other critical questions that we're confronting. So I look forward to chatting at the webinar coming up shortly. But for the here and now, good luck. Economic conditions are just hugely uncertain. The oil and petrol shock are the things that are going to determine whether we get out of this with our skin attached, or whether we actually lose some skin going through 2026. Thank you. Look forward to chatting again soon.